Hi, Greg Dorsey here at Leeb.com. It's Tuesday morning, April 5th. Technical difficulties prevented us from getting a video out last night, and I apologize, but here goes. Anyway, the stock market is at a pivotal point. It's rallied sharply since mid-March, shrugging off the twin threats of rising oil prices and the harms Japan's contraction will have on our own economy. The major averages are closing in on their former recovery highs. Getting through the previous highs may require several attempts, however. On the other hand, the market isn't acting all that poorly, so a decline seems remote. For instance, the Dow Transports, which are sensitive to changes in oil prices, have broken out to the upside. Likewise, the economically sensitive small caps are faring quite well. The Russell 2000, for instance, is just 1% below its all-time high as we head into today's trading, while our preferred small-cap benchmark, the unweighted average of all stocks in the NYSE, has already moved to record highs. We're not going to see a big downturn until we see the small caps head south. It would be highly unusual if that were to happen, ahead of the small caps turning down. We're also encouraged by the gains we've seen in corporate earnings lately. From a valuation standpoint, while stocks aren't screaming bargains here, they're not particularly expensive when taken as a group either. Now, that's not to say there aren't some sore points. Technology shares, which set the pace during the advance between August and February, have been lagging since. In part on concerns of the impact Japan's economy will have on demand, but there may also be something else to the story as well that we're just not tuned into at this point. The Nasdaq's decision to reduce Apple's weighting in the QQQ from 20% to 12% certainly isn't going to help matters today. Although we think it's a wise move, as the stock was too great an influence on the popular market average to begin with. Taking a longer-term view, we want to see continued signs that the economy is improving, and we're getting a bit apprehensive about the prospects for greater inflation in the months ahead. We're seeing plenty of signs of commodity inflation already, and the Federal Reserve and other central banks' unprecedented money printing during the last 2 years has the potential to unleash a serious price spiral. Now, while forward PEs at 14 or so aren't considered excessive, we'll remind you that in times of high and rising inflation, such as we expect down the road, PEs tend to contract. This can result in share price losses even as nominal earnings appear to be growing rapidly. Ultimately, we think we'll return to single-digit PEs on the major averages, although we're likely still a few years away from getting there. In the meantime, we think there's plenty of profit opportunities, and I say it every time I get on here, precious metals are really your best bet. And materials in general really are the growth stocks for the next several years. Well, that's all for now. I've given you plenty to digest. Be sure to stop by later in the week, and we'll have more for you. Take care.